The domino effect has been caused by loss of confidence in the financial institutions in the US. And it not only pertains to the US, but to other parts of the world. And that's arisen largely because of the extensive leverage that these institutions have used over the past number of years to build their balance sheets. For every 5% of the value of the assets that they lose, almost wipes out the capital of these institutions because they're levered 25 times. So what we're experiencing is a crisis in confidence in our financial institutions. And it seems to spread from one institution to another as people's fear takes over and they rush to liquidate their holdings in those particular companies. And nobody escapes in an environment like this. The important thing to recognize is that the Federal Reserve is not going to leave that money out in the system. To the extent, for example, that they've purchased 80% of AIG for $85 billion, in my view, that's not a bailout. That's a temporary bridge facility. That has to be repaid in 2 years' time from the sale of assets of AIG. Now, sure, to the extent that common shareholders of AIG have lost all their savings or lost all the value in their common shares, it might be perceived as a bailout. But to the extent that this is simply a bridge facility and ultimately the Fed will reclaim its money because it will have 80% of the upside of any profits that AIG makes going forward. And in my view, this is not the end of the world. We're seeing a temporary squeeze of immense proportions that's affecting global financial institutions around the world. And remember, it's global financial institutions, not the economy as a whole. It may certainly have effects on the economy as a whole, but right now it's confined to the financial institutions or the financial services sector of the world. And I think it's important to provide this assistance to the financial services sector to ensure that confidence remains not only in the financial services sector, but ultimately rebuilds confidence in the economy. It's in times like this that the market value of securities, no matter whether they're good, bad, or indifferent, is trashed along with everything else as people flee the market and go to cash. And we've seen a tremendous amount of that just over the past few days, where the urge to hold government securities, which are the highest quality, has driven the yield on US Treasury bills into negative territory. That's unheard of over the past 30 years. And to us, it's a signal that we're getting close to the bottom of this cycle. We may stay on the bottom for a while, but I think to liquidate at this point in time would be precisely the wrong thing to do. Have confidence in the businesses that you're invested in. They will recover. The financial system will recover too. It will take time, but it's going through a lot of pain right now.